Commercial banks accept deposits and use the proceeds to make loans to individuals, loans to businesses, and real estate loans. Banks borrow, lend, and earn the spread. This spread is the difference between interest income earned on lending and the interest expense paid on deposits. Is this the whole story? Well, not quite. It's a little bit more complicated than that. We have seen that modern banks are large and diversified businesses. They earn interest income from their lending business and fee revenue from other business lines. In this session, we are going to analyze the income statement of a bank. We are going to continue with JP Morgan Chase as a case study. We will see how the various business lines of JP Morgan generate both interest income and expenses, as well as fee revenue. This will tell us exactly how a modern bank turns a profit. We can break down the income statement of a bank into three parts. The first tells us about the profitability of the lending business. This is the traditional bank. It grants loans, it invests in securities. This generates interest income. It raises funds from depositors and borrows in financial markets in order to fund those investments. That borrowing doesn't come for free. Banks have to pay some interest expense. Net interest income is equal to interest income minus interest expense. This is the top line measure of bank profitability. What's left? Two items. First, we know that modern banks generate a lot of fee income. This is called non-interest revenue. Second is what's called non-interest expense. This is a catch-all for any expense that is unrelated to borrowing. It includes everything from tables and chairs to wages and bonuses. Okay, let's study all of these objects in the context of JP Morgan Chase. As we've seen before, JP Morgan's business can be broken down into two big parts. First is the traditional bank that does the lending. This contains the retail banking arm as well as the commercial lending arm within the wholesale business. This is where our net interest income is coming from. Second, we are going to see non-interest income. Remember, that's fee income. It's mostly coming from the investment banking arm. This is mainly the underwriting business, market making, and asset management. Here is the interest income and interest expense for JP Morgan. We have interest income from the loan portfolio, from investment securities held in the banking book and trading portfolio, interest on loans made to other financial institutions. Add that all up, and we arrive at the total interest income for the bank, which was about $65 billion in 2020. Interest expense is paid on deposits. It is also paid on other borrowings. These are both short-term and long-term debt. This will include coupon payments on long-term bonds that JP Morgan issues. Sum across all these items, and we have our interest expense. Interest income, interest expense. The difference between the two is our net interest income, about $55 billion in 2020. This is the profitability of JP Morgan's lending business. In order to go from net interest income to overall profitability, we need to account for fees. These are the fees here. They are listed under the bank's non-interest income. Investment banking fees, profits from trading, fees charged on deposit accounts and mortgages. These could be overdraft fees or penalties for late payments, credit card fees, asset management fees. It's a long list, but we can take a closer look at some of the bigger items. They all come from the wholesale business. First, investment banking fees, M&A advisory, equity underwriting, bond and syndicated loan underwriting. JP Morgan earned around $9 billion in fees from this business line in 2020. Prop trading. These are also called principal transactions. This is when JP Morgan's traders take speculative positions in financial markets to make profits on its own account. So this is not on behalf of its customers. This generated a whopping $18 billion of profits in 2020. And then we have fees from asset management and brokerage services. This is when JP Morgan is helping its customers invest in financial markets. The bank earns asset management fees from managing portfolios. It also earns brokerage commission fees from helping with customer trades. This business line also generated $18 billion and change. Adding up those fees gives us our non-interest income of $64 billion. For a bank as large and diversified as JP Morgan, this amount is actually bigger than the $54 billion of profit generated by the lending business. Our last block of items gives us the non-interest expense. This includes salaries and bonuses, definitely the biggest item, rent, technology, as well as marketing and other smaller items. The bank also has to pay taxes. The net income of the bank takes the net interest income plus the non-interest income and subtracts these non-interest expense items. This is the bottom line of the bank. In 2020, it was a healthy $30 billion. JP Morgan is a very large and modern bank that is diversified across multiple business lines. In 2020 at least, it had a large amount of fee income. So large, in fact, that its non-interest income was actually bigger than the net interest income generated by its lending business. Is JP Morgan a special case? Well, yes and no. Yes, it is the largest bank in the US and more diversified than the average bank. And no, because many other banks rely on fee income to support their business as well. The shift towards a fee business has been ongoing since the 1980s, when the 3-6-3 model of banking came under intense pressure. Here we can see the breakdown of net interest income and fee income for US banks in recent times. For the average bank, about 1/3 of bank revenue comes from fees. Okay, let's wrap up. In this session, we covered the income statement. We saw how a modern bank generates profits from its lending business and also from fees. In the 21st century, banks are less reliant on interest income. In an environment with persistently low interest rates and new sources of competition in the loan market, focusing on fees makes a lot of sense. It is a form of diversification that allows banks to supplement lost interest income.